Welcome back to Intermediate Accounting. This video is part 2 on Chapter 15, Stockholders Equity. And this video covers 3 primary topics. 1, treasury stock, 2, stock dividends, and 3, stock splits. In terms of treasury stock, we're going to talk about why companies buy their shares back and how to do the accounting treatment for stock buybacks. Stock dividends, we're going to talk about the 2 types of stock dividends and the accounting treatments for each, small stock dividends and large stock dividends. And finally, we're going to conclude with stock splits. Let's begin by discussing the accounting and reporting for the reacquisition of shares. This is a term we would more commonly state as treasury stock or stock buyback. Or stock repurchase. Remember that when a company buys its own shares out of this, its own outstanding shares from existing investors, when they buy them, take them out of the hands of investors, they are no longer outstanding, and this is a reduction in stockholders' equity. But let's begin by talking about some reasons why companies purchase their outstanding stock. The first 2 reasons that we're going to see here are related to the fact that the company has cash, and it makes a decision on what it's going to do with this cash. It chooses to buy its own stock, right? There's a lot of other choices the company can make with excess cash. It can expand operations, build new facilities, it can go into a new business line, it can acquire another company, it can invest in the common stock of other companies. But instead, the company decides to buy its own shares of the market. So one thing that does is it distributes cash to the existing stockholders, because we're buying the shares of stock out of their hands. So what does that typically do? That typically drives the price up as we're taking fewer, assuming that there's the same amount of demand for the stock, and we're reducing the supply by taking it out. It makes the stockholders happy because they're getting they're getting cash for their investment if they're willing to sell. And it also sends a signal to the market that this stock is worth buying. We, the company, have the most information about the company, and we're willing to take our excess cash and buy our own shares. A few other reasons that are less related. When companies offer employee stock compensation, typically stock options or just shares of stock if a certain performance target is met, and the company has to actually give shares of stock to the employees. Let's say when an executive exercises their employee stock options, those shares have to be given to the employee. Companies often will go out to the market, buy back their shares from existing investors, and use those shares. So treasury shares are often then used to be given out in employee compensation. So item 3, provide stock for employee compensation. Another reason is to avoid a takeover attempt. So let's say there's another company out there that has a lot of excess cash and it wants to take over our company. One way that it could do it is to go out to the market and keep buying up shares, more and more shares of common stock of the company. Well, how can the company prevent that from happening? It beats the other company to it and buys out many of its own shares, and that bids the price up to a point where the acquiring company might say the stock price is too high, we're not willing to do this. So item 4, reason 4 would be to thwart takeover attempts. Or to reduce the number of stockholders. Okay, let's put 5 down here. Item 5 relates somewhat to what we said here in 1 and 2. How can we make our company look better? Well, if earnings per share is the company's income, remember we said earnings per share is one of the most commonly used, if not the most common metric of a company's performance. The company's income less any preferred dividends that were paid divided by the number of shares, number of common shares outstanding. Okay, so when we buy our stock back, that's not going to affect income. It's not going to do anything to income. But when we decrease the denominator here and we say there are fewer shares, we're allocating the same amount of income over fewer shares. What does that do to earnings per share? It will automatically increase earnings per share. So that again sends a signal to the market that looks like we're performing well. Now, a sophisticated investor is not going to be fooled by this. And what else does it increase? It also increases a metric that we call return on equity. We have not talked much about. But it looks somewhat similar to earnings per share, where we have income divided by total stockholders' equity. And as we said, this buying back stock does not affect income, but it will reduce stockholders' equity. So if we reduce stockholders' equity, return on equity will also automatically increase. The purchase of treasury stock, there are two acceptable methods, of course, acceptable in terms of GAAP or as allowed by FASB. The cost method, and that's the only method that we're going to look at in this class. This is more widely used. There's also another method called the par value method. But we're going to focus on the cost method. And then one thing I want us all to always remember is that treasury stock reduces stockholders' equity. It is a contra equity account. And it also reduces the number of shares outstanding. Let's take a look at an example here of a disclosure example. Pacific Company issued 100,000 shares of $1 par value common stock at a price of $10 per share. In addition, it has retained earnings of 300,000. So let's take a look at what the stockholders' equity section of the balance sheet would look like. Under paid in capital, we have common stock. We'd always say what are some characteristics of it? $1 par value, 100,000 shares that are issued and outstanding. So we would show a dollar value of 100,000 par value, total par value of common stock. Additional paid in capital, the stock was issued at a price of $10 per share. So we would say the additional paid in capital increases by the number of shares times the difference between the market price of the stock less what was recorded as par. So 900,000 is going to be recorded in the additional paid in capital and presented separately from its common stock. We would see the total paid in capital of 1 million. Retained earnings are given to us as 300,000. And that gives us total stockholders equity of 1.3 million. Now, what happens when the company buys its own shares back or reacquires its stock? So the company later on, we saw following this information here, the company on January 20th acquires 10,000 of its own shares at $11 per share. Record the reacquisition as follows. So what we do, we're buying stock. So of course we're going to credit cash. Anytime we're buying something, we're crediting cash. We're debiting treasury stock. Treasury stock is a stockholders' equity account. And when we debit stockholders' equity, what does that do to equity? Increase or decrease it? Well, a credit to stockholders' equity will increase it. So this debit is going to decrease stockholders' equity, and that's what we expect. And we're using the cost method, so we're going to record this at the cost the company incurred in order to acquire the shares, $11 per share. So treasury stock goes up by 110,000. That causes stockholders' equity to decrease by 110,000, and cash goes down 110,000. So let's just write here, every time treasury stock is acquired, total stockholders' equity decreases. We see that here with our debit, and we see that assets decrease. Now what would, remember before this treasury stock buyback, this is what the stockholders equity section looked like. What will the stockholders equity section look like after the stock buyback, after we book this journal entry? Here we have our amounts. Common stock, we still report exactly the 100,000 shares issued, but no longer are they all outstanding, but we still have the same amount of the par value. We still have the same amount of additional paid-in capital. We do everything the same, but then down right before we get to our total stockholders equity, we have one line that says less cost of treasury stock. And we reduce the previous total stockholders equity of 1.3, we reduce it by 110,000 to get to total stockholders equity of 1,190,000. Now let's look at the reacquisition of shares, or reissuing what was treasury stock. So we have the initial issuance of the common stock to the existing stock, to the stockholders. Those are the shares that are outstanding. We then buy them back or reacquire them. And then time goes on, maybe we want to reissue them or sell those treasury shares. We're either going to do that at cost, above cost, or below cost. We're going to look at the accounting treatment for these two methods, above cost and below cost. But one thing we want to keep in mind when we're issuing shares of treasury stock or reissuing these treasury shares, whether it's above or below, they both increase total assets, because when we issue stock, we always get cash, and increases stockholders' equity. Why? Because we are reducing the contra equity account treasury stock. So if we reduce a contra account, we are actually increasing stockholders' equity. Let's take a look at our journal entry. Pacific acquired 10,000 treasury shares at $11 per share. It now sells 1,000 shares at $15 per share on March 10th. Pacific records the entry on March 10th, records the March 10th entry as follows. So the company is issuing stock, so it gets cash. How much cash does the company get? They're issuing 1,000 shares. At a market price, they get $15 per share, so cash goes up 15,000. Now remember, when we bought the shares back, let's go back a few slides. When the company bought its shares, it didn't debit common stock. It separately accounted for those shares of common stock. Once they're bought back, we call them treasury stock. So when we're reissuing these shares, we're going to decrease that contra account of treasury stock. So we're going to credit treasury stock. Now when we credit a stockholders equity account, we're increasing that stockholders equity account. And we're going to do this at the cost of what cost did the company incur when they initially issued those treasury shares? Remember, they initially issued them at $11 per share. So we're going to track that. 1,000 times 11, we're tracking that initial cost. And where do we put this difference? We received 15,000. Those shares cost us previously 11,000. Where do we put this 4,000 difference? Well, GAAP says we are not allowed to record this as a gain. It is our own stock. We can have, if this was another company's stock, we bought low and sold high, we would, of course, record a gain. In this case, when it's our own stock, GAAP says we cannot record a gain. What we do is we record the difference to the account paid in capital from treasury stock. This is a stockholders equity account used to track these not really gains, but increases in cash related to treasury stock. Now let's say Pacific sells an additional 1,000 treasury shares on March 21st at $8 per share. So we are reissuing here. We get cash because we're issuing the treasury shares. We reissued 1,000 shares at $8 per share. So we receive $8,000 cash. what are we putting back into the market? We're increasing stockholders' equity. When we bought back our common stock, we debited treasury stock. Now we are reissuing those treasury shares. So we're going to credit treasury stock at the cost. What did it cost us to buy those shares? Let's go back to that initial journal entry over here. We initially bought those shares when they went from common stock to now called treasury stock. When we bought them back, we bought them at $11 per share. Now we're reissuing them at $8 per share. Remember, this is the cost method, so treasury stock or stockholders' equity goes up at the cost of those shares, so 1,000 times 11, the cost of those shares, so 11,000. And we need a 3,000 debit. This is similar to a loss. We bought the shares at 11, we reissued them or sold them at 8. This is like a loss to us, but it's not going to go through the income statement. Instead, this loss, that's not really a loss, goes directly to stockholders' equity in the account paid in capital from treasury stock. Let's look at another example. Assume that Pacific sells an additional 1,000 shares at $8 per share on April 10th. Once again, we're getting cash. An additional 1,000 shares at $8, so we get $8,000 cash. And remember that we purchased these shares at a cost of $11 to us when we bought them from the investors. So our treasury stock account, I'm going to skip a couple lines here. Our treasury stock account, we account for them at cost. So we're going to increase treasury stock or decrease treasury stock to increase stockholders' equity. 1,000 shares times the initial $11 cost of initially buying those shares. So what else do we do? This is like having a $3,000 loss to the company. Now we know it's not a loss. GAAP does not allow us to record gains and losses related to treasury stock transactions. What do? What is our current balance in the paid-in capital from treasury stock? Well, let's look back at our last few journal entries. Here was our initial entry to buy the stock buy the stock back. We spent cash. We recorded this increase in treasury stock, which reduced stockholders' equity. Then when we reissued, we put that sort of like a gain into this account paid in capital from treasury stock. It's not treasury stock. So it has a balance of $4,000 credit. Then when we reissued more at what is similar to a loss, we reduced that $4,000 balance by $3,000. So right now we have a $1,000 credit balance. If we made a T account in the paid in capital treasury stock, we had in the former slide, we had on March 10th, we recorded an increase in the paid in capital of 4,000. This is on March 10th. And then on this date, on March 21st, we reduced it by 3,000. So after this entry is booked, we have this $1,000 credit balance in paid in capital. The accounting rules say we can't have a negative balance in paid in capital treasury stock. We have a credit balance, negative meaning we can't end up with a debit balance. We still have 1,000 here. The first thing we're going to do for this $3,000, similar to a loss, kind of like a loss, first thing we do, eliminate any balance. Eliminate the credit balance in the paid in capital treasury stock account. Okay, so we're going to record a debit to paid in capital treasury stock for 1,000. So going back here, we just recorded a debit of 1,000 on April 10th. And now we have no balance in paid in capital treasury stock. We're not letting that balance ever become a debit balance. Then any amount above that, right, we still are trying to account for a $2,000 difference. What do? We record the remaining amount I'm going to call this a, record the remaining, I'm going to put this in quotes, loss, because it's not really a loss. It's not going through the income statement, in retained earnings. So we're going to debit to reduce retained earnings by the difference, 11,000 less the 8,000 and the 1,000 that we've accounted for. So this kind of like a loss is a $2,000 decrease to retained earnings. That concludes our discussion of treasury stock. Stock dividends and stock splits are the issuance by a company of its own stock to stockholders on a prorated basis. So typically when we're talking about dividends, we're talking about cash dividends, a company giving out cash, stock dividends, and stock splits have some similarities to stock dividends. Or when the company says, we don't have enough cash to give as cash dividends, but we want to make our investors happy, what if we gave them shares of our own stock? That doesn't cost us cash. And then the investors that get additional shares can always choose to sell them for more cash if they want to. The issuance of a company's own stock to stockholders on a pro rata basis, meaning if I'm an existing shareholder and I have 1 share and the stock dividend is 20%, I now have 1.2 shares of stock. And this is all without the company receiving any consideration, which consideration is just a fancy way of saying it, no cash in return. But consideration is more general because remember we said that stock can be issued for more than just cash. Stock could be issued in exchange for plant, property, equipment. It could be exchanged for services that are rendered rather than the company paying cash. They can just give out shares of stock to, let's say, their accountant or their lawyers. So we just call this general term consideration. Typically, it would be cash. If the stock dividend is less than 20 to 25% of the number of common shares outstanding, then the company transfers the fair market value of the shares that are issued in the stock dividend, of the shares or of the additional shares that are given as dividend, from retained earnings into common stock, the common stock account. And less than 20 to 25% of the number of shares, this is referred to as a small stock dividend. There are different rules for a large stock dividend, as we'll see in a minute. Before we do, let's look at an example of a small stock dividend in the accounting treatment. Vine Corporation has outstanding 1,000 shares of 100 par value common stock and retained earnings of 50,000. If Vine declares a 10% stock dividend, it issues 100 additional shares to current stockholders. We just say the number of shares before the dividend times the amount of the stock dividend of 10%. So we're giving out an additional 100 shares. If the fair value at the time of the stock dividend is $130 per share of stock, what is the entry? The date that the dividend is declared, it's going to be a few days before the date of the actual distribution. So on the date that the dividend is declared, or the declaration date, the company is going to decrease retained earnings. Sometimes we call this a transfer out of retained earnings and into the common stock account. So remember, the common stock has a par value, so we're going to have common stock. And since this is not the actual date that the dividends are distributed, we're going to use this special account, common stock dividends distributable. This account's only going to be active for a couple days until we actually distribute this. And then this is going to be at par, and we're going to have another account for paid-in capital in excess of par. Related to the common stock, of course. Okay, so now that we have the accounts, the next step is for how much. So we said in the last slide, we're going to transfer the amount at the fair value, the fair market value of the shares that were given out. So what is the fair value of the 100 shares given out? Retained earnings increases by the 100 additional shares times the fair market value of the shares of stock, 130. So retained earnings increases by 13,000. This increase to the common stock dividend distributable account is going to be at par value, so the 100 shares at the common stock's par value, which we need to be told. Here we see it's at 100. So this account increases by 10,000. And then this difference, the 100 shares times the difference between the market price and the par value, this 3,000 goes into paid-in capital in excess of par common stock. Then on the date of the distribution, all we need to do is reduce this account, debit common stock, dividends distributable, and credit common stock now that we've actually given out those shares of stock. It's no longer distributable. This common stock dividends distributable account that we see here, this is a stockholders equity account. It never lasts very long because just a few days after we declare, we typically pay up, settle up. So this will just be around for a couple days, and this would be included a credit in the stock. It would increase stockholders equity. There's no difference to stockholders equity when we actually distribute. We say we no longer are about to distribute them, we just have distributed them. So what's the net impact of these two entries? We reduce retained earnings by 13,000, and we increase the common stock and paid-in capital in excess of par on common stock by 13,000. Before we get to large stock dividends, let's momentarily take a look at stock splits. Stock split, most common is a 2-for-1 stock split. Board of Directors says on this date, all our existing stockholders, instead of having, we currently have 1 million shares outstanding, all of a sudden we're going to have 2 million shares outstanding. Any investor who holds 1 share now holds 2 shares. Now the investor is not actually that much better off because instead of, let's say the stock had a $10 market price per share, it will now be 5. So whether I have 1 share of stock at $10 a share or I have 2 shares of stock at $5 per share, it doesn't make that much difference to me. I'm not any wealthier. Why would companies split their stocks? To reduce the market value per share for individual shares. Market price of individual shares. The total market value of the firm, of course, doesn't change. Why would you do this? Well, consider Amazon stock getting so high over the last 20 years, and we're pricing out certain investors that are never going to be able to afford 1 share of stock. So if we split the stock, maybe 10-for-1, now we have much more affordable shares at a fraction of the ownership, and more people might be able to buy those shares that wouldn't have before, perhaps. There is no entry that needs to be recorded when there's a stock split because, as we said, it doesn't really affect the company's value at all. What we do is there will be a decrease in the par value, decrease the par value and increase the number of shares, and will offset such that the company is no better off and any individual investor is not really any better off. So here we see stockholders equity before a 2-for-1 split. There's 1,000 shares at a 100 par. We can't see what the market price is here. Remember, the market price is never shown on the balance sheet. So we see common stock with at a book value of 100,000, retained earnings of 50,000. After the 2-for-1 split, what happens here is these 1,000 shares become 2,000 shares, but instead of them having a $100 par, they now have a $50 par. So your total book value of common stock is the same, and there's no impact whatsoever on retained earnings. Now that we've covered that, now let's go to a large stock dividend. Large stock dividend is when the company issues more than 20 to 25% of the number of shares previously outstanding. What do we need to know about this? It has the same effect on market price as a stock split. We're saying we're giving out so much of the stock, it's kind of like a split. What are the accounting rules? Well, remember with the small stock dividend, we transferred the fair market value of the shares out of retained earnings and into the common stock account. We don't do that here because we say we're not really sure the market value, the market price is going to change by this amount of the dividend because it's so big. So what we do is we transfer the par value. So the par value of the additional dividends given is transferred from retained earnings. Par value, not fair market value, not fair value. From retained earnings to the common stock account. Or if this were preferred, to the preferred stock. So I guess more generally we could say to the capital stock account. And let's take a look at an example. Rockland Steel declared a 30% share dividend or stock dividend on November 20th. It's payable on December 29th to the stockholders of record as of December 12th. Now, I want to point out that this stockholders of record, that is not relevant to our accounting. That has legal implications that tells us who is going to get it. But from an accounting perspective, we care about the other dates. November 20th, it was our dividend declaration date, and December 29th is the actual dividend distribution date. The date of the declaration, 1 million shares, par value 10, are outstanding, and they have a fair value of $200 per share. So we need to know, how do we account, first of all, what is the amount of this transfer out of retained earnings and into the common stock account? What is the amount? Well, we have 1 million shares that were outstanding. We have to ask ourselves first, is this a large stock dividend or a small stock dividend? 30% meets the large stock dividend criteria. So the amount that we're giving out is 300,000 additional shares. And since this is a large stock dividend, that tells us the dollar amount at which we're going to transfer from retained earnings into common stock. Remember, with a small stock dividend, we did the transfer at fair value per share. However, with a large stock dividends, we expect that we're giving out so much shares of stock that this market price is actually probably going to change. So what we do is we do that transfer out of retained earnings and into common stock at the par value. Par value because this is a large stock dividend. So we are transferring 3 million out of retained earnings and into common stock. Now, technical accounting entries, technical accounts that we're going to use here on November 20th. This is the declaration date. So we're not going to exactly increase common stock. We're going to use the account common stock dividends distributable. So on November 20th, we reduce retained earnings, debit retained earnings for 3 million, and credit common stock dividends distributable for 3 million. Again, we ignore the date of record, but then on the actual declaration, the actual distribution date, which is December 29th, this is the date that our stockholders get the actual stock dividend. Nothing happens to retain earnings, but we decrease and debit common stock dividend distributable and we increase common stock for 3 million. Very briefly, I'm going to show how we present or report or disclose the stockholders' equity section of the balance sheet. Here we see a title of capital stock. We have preferred stock, common stock. Separately, we're reporting the additional paid-in capital on that preferred and common stock for total paid-in capital amount. We then have our retained earnings. Finally, a subtotal for total paid-in capital and retained earnings. And then from that, we subtract out the cost of the treasury stock. After that, we report any accumulated other comprehensive income or subtract any accumulated other comprehensive loss, and that gives us our total stockholders' equity.